if you look at the near-term futures contract in New York, back on January 9th, I didn't check what news was happening on that day, but there was a 50% jump in March futures premiums of spot over the futures price. And really what it is you have markets telling you that they're expecting higher silver prices to come. If you look at the longest dated futures contracts, we're looking at a $5.50 premium over spot. That's the highest it's ever been. Even since when silver was $50, again, the market's signaling that they're expecting higher prices in silver to come.
Exciting things are happening in the silver market. Prices have experienced a remarkable rise, reaching an impressive $30.64 per ounce, a 10% increase this Tuesday. Various dynamic factors fuel this surge, such as supply constraints and smaller price gaps between New York and London markets. At the heart of this rally is the exciting growth of China's solar industry and the rising global appetite for clean energy technologies. Market analyst Peter Krauth, a well-respected authority in the world of precious metals, sheds light on some intriguing regional price disparities. Did you know that silver prices in China currently come with nearly a 10% premium compared to the US? The situation is even more striking in India, with premiums soaring 20% above US prices. This is partly due to the devaluation of the rupee. Still, it also reflects the strong demand emanating from Asian markets, especially from China's flourishing solar and tech sectors, which are major consumers of silver. In addition to these factors, the recent Federal Reserve rate cut and a weakening US dollar have made silver an even more attractive safe haven asset. Metal continues to find new applications in modern technology, driving demand from various industries, including electronics, solar panels, batteries, and semiconductors, which are particularly noticeable in markets like India. However, we should also monitor supply concerns escalating as primary exchange inventory levels reveal alarming trends. The London Bullion Market Association, the largest silver exchange in the world, has reported a decline in inventories for 9 months in a row. As of August 2022, LBMA vault holdings dropped to 916.5 million ounces, the lowest level seen since July 2016. This represents a significant decrease of 21.7% from the peak of 1.170.6 billion ounces in November 2021. Krauth's insights indicate that these LBMA silver inventories peaked in 2021 and reached a 10-year low, with a staggering reduction of 23 million ounces in December alone. Out of the 825 million ounces currently held in London, nearly 60%, 525 million ounces, is allocated to exchange-traded funds, further tightening physical silver availability. This unique combination of shrinking inventories and increasing industrial demand has many analysts buzzing about the possibility of a potential silver squeeze on the horizon. Before diving deeper into this exciting subject, subscribe to our channel, hit the bell icon for notifications, and share this with friends or anyone who might find it useful.
Now, big deficits are expected in the silver market, and this goes back to 2020. It's Bank of America Global Research and Incrementum that looked at and did this research, and they said, if you look at all the base metals and you look as well at platinum and silver, how did things look going out 10 years? And by far, the biggest deficits would be in silver, up to the tune of 120%. So I don't know how mathematically that can happen. I can only imagine that, the secondary inventories are going to be long gone. We're going to have to be tapping into private hoards of silver, and you have to ask yourself, at what price is that actually going to take place? Some really interesting research has come out of TD recently, and they've titled it sleepwalking towards a silver squeeze, and that really the market is missing this almost completely. And what they're saying is that if you look at the price of silver futures and the exchange of those futures to physical, the premiums have really gone out of whack and they're abnormally high, and it implies that the market participants are really choosing to take delivery of physical metal to avoid these potential tariffs that Trump is talking about on future deliveries. So technically what's happening, if you want to summarize it quickly, is this. The metal is flowing mostly from London to New York on Trump tariff fears, but where London is the 800-pound gorilla, only 30% of London silver is actually available for delivery. Here's kind of how it looks. So this is silver inventories at the LBMA over the last 10 years. You can see that they peaked around, I think it's 2021. I don't have the years at the bottom. That's approximately where it last peaked. And we're down. We're at near 10-year lows. December, the last month we have numbers for, was down 23 million ounces. And here's a little perspective of how the inventories break out in London. 825 million ounces of silver. ETFs represent about 60% of that, 525 million ounces, so that's not available. So that leaves a free float of about 300 million ounces. Daily trading requires about 250 million ounces, so your buffer is only 50 million ounces. That's also near historical lows. So very, very tight market. In New York, they have about 300 million ounces. Only 23% of that is what's considered registered silver, so that's just 70 million ounces. That's what's available if someone wants to take delivery of their silver. So on the COMEX, silver inventories have recently spiked. That speaks to this delivery or these transfers of metal coming from London and going into the New York market. We've seen also people taking their silver out of New York, asking for physical delivery. We have a spike again in the month of December, an outsized spike. In Shanghai, we've seen also this spike in silver inventories. I think that also speaks to metal flowing from London and going to these markets that want to avoid tariffs. And if you look at the premiums, this is not as high as it's been, but it's spiked again just very recently. We're at almost 10% premiums in China over US prices for silver. In India, I'm going to look at the premiums as well in a second, but we've seen a lot of silver flow into India. For different reasons, they're buying silver a lot as well. We've seen silver ETFs, and their average is about $40 million US per month flowing into silver ETFs, and they've only been created back about 3 years ago. And the premiums, as I say, they're a little bit different, but they're 20% in India over US prices for silver. And that apparently is being driven more by rupee debasement. And if you look at the near-term futures contract in New York, back on January 9th, I didn't check what news was happening on that day, but there was a 50% jump in March futures premiums of spot over the futures price. And really what it is you have markets telling you that they're expecting higher silver prices to come.
Looking toward the future, market analyst Peter Krauth is optimistic that silver is transitioning into a bullish phase, driven by strong industrial demand, significant investment interest, and tight supply conditions. These factors could trigger a substantial rally in silver prices, with a market squeeze potentially adding even more momentum. As we gaze ahead to 2025, gold prices are expected to hold firm, buoyed by ongoing central bank purchasing and steady safe haven demand amidst global geopolitical uncertainties. However, silver could shine even brighter, with the potential to outpace its golden counterpart due to its extensive industrial applications, particularly within the renewable energy sector. The solar energy industry is poised to remain a crucial driver of silver demand. Although Krauth anticipates a slight moderation in growth rates compared to the explosive expansion from 2021 to 2024, the numbers are promising. Now let's return to this captivating discussion.
Here you have SLV, the largest silver ETF. Since July or so, we've started to see silver ounces held by SLV. They've started to flow back higher. That hadn't been the case for a couple of years. I think that the big industrial consumers were tapping into those ETFs to get physical metal. That started to reverse as well. And this sort of a little side note geopolitical thing, it speaks to the changes that are happening. Russia's central bank has for the first time said now they're going to start adding silver to their reserves, diversifying from gold, platinum, and palladium. And back in December, or end of November, they said that they were going to temporarily ban the export of waste and scrap precious metals from December all the way through to May. So they really want to keep their silver at home. This is going to have, it might be a small impact, but it piles up on top of everything else in terms of availability of silver. So are we approaching a squeeze? Time will tell. But if you look back and you adjust for inflation, that spike in 1980 at government CPI numbers would put you at $145 today. It just speaks to the potential for where silver could possibly go. The silver price, once the Fed starts to cut rates, within 24 months, on average, in the last 3 rate cutting cycles, silver has spiked has risen 32%. If you look at from the bottom or the middle of a rate cutting cycle, over the last 3 rate cutting cycles, silver has actually averaged 332% gains over the last 3 rate cutting cycles. In silver, what we have is, if you add up the different aspects of it, the fundamental, the sentiment, and then the technical aspect of it, you really do see an emerging silver bull market. So we clearly have rising industrial demand. We're at deficits. The industrial demand is at the very least stable. I think it's steadily rising, and it's going to help to provide a rising floor under the silver price. We have investment demand that ebbs and flows, but when it flows, it really comes back strongly. And that's really the wild card that causes these spikes in the silver price. And then you have limited supply. We know that. And that, along with a potential squeeze, I think are the ingredients for another silver rally and silver bull. So if we look at the fundamentals, demand outstrips supply. We know this from the Silver Institute. The last 4 years have seen a silver deficit. They think that these are going to persist for years to come. They're not even giving any kind of a timeline. They're just saying the next several years we're going to continue to see deficits. They're even saying we're going to see record deficits within the next 5 years. So, I'm a little bit on the fence on in terms of the growth in solar. I think it's going to continue. I do think it's going to slow down. It'll continue to grow, just not at the same pace that we've seen in 2021, 22, 23, 24. So I think that's going to continue contributing to demand for silver, just not at quite the same rate of growth as we've seen before. That being said, we have a history of underestimating demand from solar. So this chart tells us that if you go back to 2010 and you look at 5-year forecasts of solar installations, they were actually more than 3 times higher than those 5-year forecasts. So solar really surprised a lot of people in terms of how much solar was going to be installed and how much, obviously, that bled into silver demand.
As we move forward, gold is expected to maintain elevated prices in 2025. Its well-established status as a financial security asset ensures it remains a steadfast store of value, especially in these unpredictable times. Concerns about inflation, economic volatility, and political instability seem likely to persist, further fortifying gold's resilience and solidifying its cornerstone in many investment portfolios. We'd love to hear your thoughts on the exciting future of gold and silver prices. Share your views in the comments below. If you enjoyed this discussion, be sure to like, subscribe, and hit that bell icon for more updates. Thank you for being part of our community.